Hey, good Sunday morning to everyone. This is your favorite YouTuber, Mariusz Konieczny. I want to talk about dilution today. You see, I think there's a lot of investors out there that have a particular opinion about dilution. Like, for example, dilution is bad, or if a company announces capital raise at let's say the stock is trading at $1 and then the capital raise is announced at 90 cents. People make the assumption that after the capital raise is announced that the stock is going to fall to whatever the capital raise was at. And I had a lot of those kinds of preconceptions or rule of thumbs about capital raises or private placements, and as I became involved in many of them, I realized that there are no rule of thumbs, and just because a company is diluting, raising money and issuing shares doesn't automatically mean that this is bad. You see, it's all in the context of things. So for example, let's say if you have a business and you develop a particular product or particular service, well, in order to grow revenues or to sell this product, you need money, okay? Because the product doesn't just sell itself. You have to put some effort into selling it. You have to show it to clients, you have to potential clients, you have to go to conferences, you have to hire salespeople, maybe you have to increase your infrastructure. I mean, it all costs money. So the product doesn't sell itself. And as a result, a lot of times you have entrepreneurs, they are looking for money. They are looking to raise money from angel investors or family and friends for that particular purpose. And in return for this, they obviously have to give something up. So they give up a partial ownership in a particular business or particular thing, right? So it's not just like, oh, a capital raise is bad. And we've all been in this situation where you own a stock and then the company comes out with a capital raise and we get annoyed because our ownership is diluted. The only time when we don't get annoyed is when we actually ourselves participate in the capital raise, so we don't get diluted. But you see, there's different reasons why companies raise money. So they might want to raise money for an acquisition, or they might want to raise money because the product is successful and they need to accelerate the growth. It's what matters is what the capital raise is for, not necessarily that there is capital raise. Okay. Now, what is bad? When capital raise is not good for you is when the capital raise is, let's say, just to keep the ship from sinking. That's bad. Okay. But when I'm looking at one company right now that disappointed investors over the years tremendously. Like, the number of shares or the dilution went from, I'm going from memory, like 2 million shares to like almost 40 million shares. I mean, that's massive. And all of the dilution came because the company was unsuccessful. It was unsuccessful in selling the product because the product wasn't ready. So the company was losing money every year. Those losses have to be covered by someone, right? So it either had to come from debt or equity, and it just was ongoing, and investors got like diluted tremendously. But like recently, finally the company started to grow because the product was finished, the clients are signing up, And if the company were to do a capital raise like right now, it wouldn't be as dilutive, because now investors are happy. They see that the revenues are growing and the market cap is higher. So they are happy to finance the company, but at higher prices. But in such case, the same company that disappointed so much in the past, now it's in a completely different situation, because now the capital raise would be for a very, very beneficial purpose. It would be to, hey, we're raising money because we want to accelerate the growth. We're raising money because, look, the product is so fantastic and we want to get it into the hands of more people, and we need to raise money. That's a fantastic way of doing it. So there's no like one rule of thumb: capital raises are bad or capital raises are good. It all depends on what they're for. And I don't know if you guys read George Soros, like the theory of reflexibility or something like that. Anyway, what he was talking about is that the stock price of a particular company can have an impact on the success of the company. A lot of times we think of, the stock price doesn't matter. The business itself matters, and then this will dictate the stock price. That's what I thought too for many, many years. But there's more to it, because the company that I just did a private placement with and I put so much money into, it's a very interesting situation, because they have a product that is, for general public or for regular people, and they have a system or a formula, or however you want to call it, where it costs them a certain amount of money to acquire a customer. Okay, so it costs them like $50 to get a customer, but because that customer pays about $100 a year, and it's a sticky customer, and it's like a SaaS business model, that customer, in the stock market is valued at a multiple of a revenue, especially when those revenues are high margin revenues. You see a lot of these SaaS companies on NASDAQ trading at 10 to 20 times revenues, especially when they're growing. So a customer that pays you $100 per year is worth between $2,000 and $3,000, or no, if it's 10 times revenues, it's worth $1,000. If it's 20 times revenues, it's worth $2,000, right? So let's just stick with $2,000. So in this case, they are paying $50 to acquire a customer, and that customer is worth $2,000, right? So they are growing, they are signing up people at a particular rate. Now, this is where the stock price and the value of the company comes into play, because if they want to accelerate that growth, they could say, hey, we're going to dilute 5 or 20 or 10%, whatever. We're going to dilute, because that dilution is going to turbocharge our growth. And if we're only diluting, let's say 10%, but with that dilution, we can turn every $50 into $2,000 worth of value. That's accretive. That's what you want to do, and that's exactly why the stock price is going up. Because when you have, let's just call it $10 million in the bank, right? $10 million is on the balance sheet, and the $10 million is only worth $10 million because it's on the balance sheet. But that same $10 million, if it can be used to acquire a customer for $50 and turn it into $2,000, well, that customer, that $10 million in the bank is really going to be worth multiples, 10, 20, whatever times what it is in the bank. And I remember reading the quote from someone, I don't know who it was, saying that $1 on the balance sheet is worth $1, but $1 on the income statement is worth $10. So that's kind of, the situation that you have. And so if you have a company like this that, you know, has that formula, $50 to acquire a customer, that customer is worth $2,000, and you do a capital raise, and then people were like, oh, they have so much money in the bank to turn it into this much value. Then when the stock price goes up, they can do it again. They can raise now more money again, and it's less dilutive because the stock price is higher, and then that capital raise can accelerate the growth of the company again. So that's kind of like an example of what George Soros is talking about, is that the stock price and the business are not completely separate. They can actually help each other. And then the same thing happened, you know, with what Oracle did. They were raising money, very little money at first, because the stock price was very low and it was very dilutive. But the moment the company became a little bit more valuable in terms of market cap, okay, they were like, all right, well, at 60 cents, let's raise this much money. And then the market said, oh, wow, they have this much in the bank. They're not going to go belly up. They can take this property from A to B. And then they assigned a higher market cap to the company. And then the company came back and did it again at $1.20. And then the market got even more excited, because the market was like, wow, they have $20 million in the bank. And with $20 million in the bank, they can take the historicals into 4311 compliant, blah, 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 blah. And now, as we're looking at the stock price that's, you know, between 250 and 350, I know it fluctuates. Now it's like at 250. But let's say they take the drilling, which they have the money, right? They're drilling, and let's say they have some results, and the results are fantastic, and then the stock price goes up. Then they can say, hey, you know, let's do 5 or 10% dilution, raise $50 million, and that $50 million can do this much for us, right? So I just wanted to point it out to you that not all capital raises are bad. Actually, the ones that are productive are fantastic. So what matters is what it is that the company is doing with this money, and how this money is going to be beneficial to the whole picture of the company, or the growth profile, or signing up customers, or anything like that. So anyway, that's my morning talk Sunday. Have a good Sunday. Talk to you later.